Welcome to the Deep Dive. Today, we're focusing on ChargePoint's recent earnings call.
That's right. It covered their first quarter of fiscal year 2026, the period ending April 30th, 2025.
And our mission, as always, is to cut through the jargon, pull out the key insights, really just give you the core takeaways from what management discussed.
Yep. We'll break down the results, the strategy they laid out, and what they're seeing ahead. All straight from the call.
Okay, let's dive right in. First up, the snapshot results for Q1. How did the top line look?
Revenue came in at $98 million.
$98 million. And how did that compare to what they'd guided for?
Importantly, they mentioned it was right within their guidance range. So no big surprises there. They met expectations for the quarter's revenue.
Okay, good. What about the margin picture? I heard there was some positive movement there.
Yeah, that was definitely a brighter spot. They hit a new high for their non-GAAP gross margin.
A new high? What was the number?
31%. And that's, been trending up nicely over the last few quarters.
31% non-GAAP gross margin. Okay. And the bottom line, adjusted EBITDA.
The non-GAAP adjusted EBITDA loss was reported at $23 million for the quarter.
$23 million loss. How does that stack up against previous periods?
Well, it's a bit higher than the $17 million loss in the prior quarter, Q4. But, and this is key, it's a pretty significant improvement from the $36 million loss they had in Q1 last year.
Ah, okay.
Yeah.
So sequentially a tick up in the loss, but year over year moving in the right direction.
Exactly. A solid step towards that profitability goal they keep talking about.
Got it. So headlines, $98 million revenue, 31% non-GAAP gross margin, $23 million non-GAAP adjusted EBITDA loss. Let's unpack those a bit. What's driving the revenue?
Sure. So as you break it down, network charging systems, it's basically the hardware, brought in $52 million.
Okay, about 53% of the total. How did that perform?
It was actually flat compared to the previous quarter, sequentially.
Flat sequentially, which they noted was maybe a bit better than typical Q1 seasonality might suggest.
Right. But looking year over year, hardware revenue is down 20%. So a mixed picture there.
Okay. Then there's the subscription side.
Yep. Subscription revenue, that's the software, the services, the recurring stuff. It came in at $38 million, about 39% of the total revenue.
And how did that do sequentially?
Also flat sequentially. But they gave a specific reason for that.
Oh, what was it?
Fewer days in the quarter. Apparently, it affects how that prorated revenue gets recognized. So not necessarily a sign of slowing momentum in the underlying recurring business.
Ah, okay, so more of a calendar quirk than a business issue. What about year over year for subscriptions?
That's the key number.
Yep.
Up a strong 14% year over year.
Nice. And that's tied to the installed base growing, right? More chargers out there means more recurring revenue.
Precisely. It's less volatile than the hardware sales quarter to quarter.
It makes sense. And the last piece was other revenue.
Yeah, $8 million, just 8% of the total. That was down both sequentially and year over year.
Why was that?
They put it down to lower one-time project revenue. Stuff that's just naturally lumpy and not really core to the ongoing business trends.
Okay, so mostly hardware and subscriptions driving things. How about the mix of customers? Commercial, fleet, residential?
Based on billings, commercial is still the giant piece, 71%. Fleet was 13%, and residential was 12%. The rest, other, was just 3%.
Heavily weighted to commercial. And geographically, still mostly North America.
Oh, yeah. 85% of revenue from North America. Europe came in at 15%.
15% Europe. Did they comment on that? Seems maybe a bit low.
They did. They specifically said it was lower than normal for them. Pointed to weakness in Germany as a particular drag.
So Europe was a headwind. Did North America make up for it at all?
It helped a bit. North America was actually slightly higher sequentially.
Oh, interesting. Even with Q1 seasonality and macro concerns.
Exactly. They highlighted that resilience in their core market, which helped offset some of that European softness.
Okay, let's circle back to that 31% non-GAAP gross margin. That's a pretty big jump, up 7 points year over year. What exactly is fueling that improvement?
Well, it's coming from a couple of places, according to management. First, margins improved in both the hardware segment and the subscription segment.
Okay, so better performance within each line.
Right. And second, that higher margin subscription revenue grew as a percentage of the total mix. So just having more subscription revenue automatically helps pull the overall average margin up.
Got it. A combination of better unit economics and a favorable mix shift. Any more detail on the hardware margin improvement? You mentioned it was down 20% YoY revenue-wise.
Yeah, interestingly, they said hardware gross margin actually improved sequentially, quarter over quarter.
Even with tariffs and freight costs they mentioned.
Even with those headwinds in Q1, yes. which suggests they're making progress on, underlying product costs or efficiencies or maybe selling a richer mix of hardware.
That points to some operational strength.
Yeah.
And the subscription margins themselves, you said they were higher.
Very high. They hit a record 60% on a GAAP basis for subscriptions. Non-GAAP would be even higher.
60%. Wow. How are they achieving that?
They talked about economies of scale. As the subscription base gets bigger, the cost to serve each additional customer goes down, and also optimizing their support costs.
Makes sense. So looking forward, do they expect margins to stay at this level or even improve?
The expectation they set was for margins to sort of hover around this 31% range in the near term, Q2 basically. But they do see potential for further improvement later in the fiscal year.
What about tariffs? Are those going to bite into margins later?
They address that directly. They expect a minimal impact on COGS, cost of goods sold from tariffs.
Minimal.
Mitigation efforts they already put in place. In fact, they sounded pretty confident that the other cost reduction initiatives they have underway will actually exceed any negative impact from those tariffs.
Okay, so they feel they have a handle on tariffs and see a path to potentially even better margins later this year. What about operating expenses, OpEx?
Non-GAAP OpEx was $57 million. Now, that was up about 9% sequentially.
Why the jump quarter over quarter?
Mainly annual salary increases hitting in Q1, plus some specific investments they decided to make.
Okay, but how does that compare to last year?
That's the more telling comparison. Down 15% year over year. So it shows they are maintaining cost discipline compared to where they were a year ago. They definitely emphasize they're managing OpEx closely.
Right. So putting it all together, the revenue, the much improved margins, the controlled OpEx, how does this frame their path to profitability? That $23 million adjusted EBITDA loss.
Well, moving from a $36 million loss last Q1 to $23 million, this Q1 is definitely progress on that path year over year.
And they're still aiming for positive adjusted EBITDA soon.
Very clearly. They reiterated their goal is to achieve positive non-GAAP adjusted EBITDA in a single quarter sometime during this fiscal year, FY26. That's the target they've set.
Okay. And just for context, I mentioned stock-based compensation.
Yeah, that was $18 million in Q1. Important to remember that's a non-cash charge that gets added back for the non-GAAP adjusted EBITDA number.
Right.
But it is a real expense on the GAAP side.
Got it. Quick check on the balance sheet. Anything significant there?
Inventory ended at $212 million. They did note it was up $3 million from Q4.
Inventory up. Is that concerning?
They clarified that. So the increase was entirely due to foreign exchange rate movements impacting the value of inventory held overseas. On a unit basis, actual inventory levels decreased for most products.
Ah, okay. So not building up unwanted stock. Are they planning to reduce that inventory level?
Yes. They expect to gradually bring that balance down throughout the year, which should, help free up cash as they convert inventory into sales.
A cash position.
Ended the quarter with $196 million in cash. They did point out that Q1 is usually their highest cash usage quarter because of timing on some big annual payments.
Do they have access to more liquidity if needed?
They highlighted they have a $150 million revolving credit facility that's completely undrawn. Plus, no debt maturities coming due until 2028.
And they mentioned an ATM facility too.
Right, the at-the-market equity program. That gives them the option, if they choose, to sell some stock gradually into the market over time. Another potential lever for capital.
Okay, so the balance sheet seems pretty stable for now.
That was the message, yeah. Supports their current plans.
All right, let's shift gears from the numbers to the strategy and the market itself. What were the big themes they focused on?
They really framed the whole year around two main priorities, delivering innovation and driving growth.
Okay. And did they point to specific wins or signs of momentum?
They did. They mentioned the DC fast charging program they have with GM, said it's accelerating, sites opening faster. And GM actually just signed off on adding over 500 more ports to that program.
That sounds like a positive sign. Any others?
Extended agreements with Mercedes-Benz. And remember that theft-resistant charging cable they announced.
Yeah, the one designed to combat copper theft.
That's the one. They said there's strong market interest, and it's on track for production this summer for their own hardware.
Good progress there. What about the software side? Energized.
The key there is the breadth and scale. That platform can manage chargers from tons of different vendors. They said it now supports over 700 different charger models from more than 85 manufacturers.
Wow. That's a lot of compatibility. Shows their reach across the ecosystem.
Definitely. And speaking of scale, the overall network numbers are pretty big now.
What did they report?
Over 352,000 ports under their management globally. That includes over 35,000 DC fast chargers. And in Europe specifically, they have over 122,000 ports.
Plus roaming access, right?
Right. Through their roaming partnerships, drivers using their app can access over 1.25 million ports worldwide. It's a huge virtual network.
They did talk about the market being a bit tough, though. Macro headwinds, uncertainty.
Acknowledged, yes. But they use the word resilient to describe how the business is performing despite those conditions, both on revenue and the bottom line progress.
Did they see any positive trends underneath the surface noise?
Yeah, a couple of big ones. First, just the continued growth in EV adoption.
More EVs being sold.
Exactly. They cited data showing 16% year-over-year EV sales growth in North America for Q1, and even stronger in Europe, 22% year-over-year growth there, according to RowMotion. Plus, the EU's 2035 mandate helps solidify that European trend.
So more cars needing chargers eventually. That's the long-term tailwind.
That's the idea, a strong leading indicator for the charging industry. The other trend they highlighted was charger utilization rates.
Utilization, meaning how often the chargers are actually being used.
Correct. They mentioned a report showing many U.S. cities are getting close to peak capacity during busy hours. 5 major markets apparently approaching 40% utilization during those peak times.
40%, that sounds high. Good for ChargePoint's customers, maybe less so for drivers looking for a spot.
That's exactly the dynamic they described. For drivers, yeah, it can mean lines and frustration. But for their customers, the site hosts who own and monetize the charger's higher utilization is great news. It means more revenue from their existing assets.
And the theory is that drives demand for more chargers.
That's what management expects. Seeing good returns on current chargers should encourage those customers to install more in the future.
Interesting dynamic. Did they comment on competitors or market shifts?
Briefly, mentioned seeing some market attrition, some players voluntarily exiting. Also noted increased scrutiny on some Chinese competitors trying to enter the market.
And they see that as an opportunity.
They framed it as creating a meaningful opportunity for ChargePoint to gain market share, given their established presence and some others potentially pulling back.
Okay. But they aren't just waiting for that to happen. They announced 2 pretty major initiatives. Let's start with the Eaton partnership. What's that about?
This sounds like a big one. It's about integrating ChargePoint's EV charging hardware and software with Eaton's electrical distribution equipment.
So combining the charger with the stuff behind the wall that powers it.
Exactly. They're positioning it as an end-to-end solution, from the building's electrical panel right to the car, addressing what they called a major market gap. Available now, apparently.
What's the benefit for the customer installing this?
Faster deployments and lower overall project costs. Instead of piecing together the electrical upgrades and the chargers from different vendors, you get an integrated package. Should simplify things, especially for larger or more complex installs.
And there's a future element too, co-development.
Yes. They plan to work with Eaton to develop future integrated products, aiming for even lower costs, better efficiency, and also advancing things like V2X capabilities.
V2X, vehicle to everything, like sending power back to the grid or building.
That's the idea. Vehicle to grid, V2G, vehicle to building, V2B. Using the EV battery as a resource, they expect the first innovations from this Eaton co-development around September.
That sounds potentially transformative down the road, but the immediate win with Eaton is market access.
That seemed to be the biggest immediate focus. Gaining access to Eaton's huge go-to-market machine. Eaton does something like $25 billion in annual sales, operates in over 160 countries.
So ChargePoint gets plugged into that massive sales channel.
That's the plan. They explicitly said they anticipate incremental revenue growth from this relationship. They see it cementing their role across the whole EV ecosystem.
Okay, that's Eaton. What was the second big announcement? Something about AC hardware?
Yeah, a whole new AC hardware architecture. This is the first product line coming out of a new lower-cost co-development structure they've set up.
Lower cost for them to make.
Right. Designed to hit a highly competitive price point in the market, but crucially, also designed to increase their own gross margins on these units.
Lower cost, higher margin, competitive price. Sounds like the trifecta.
That's the goal they described. And this new architecture isn't just for one product. It's going to be the foundation for a whole range of new AC charger models rolling out over the next year.
For which markets? Home, commercial.
All of the above home, commercial, and fleet uses. They expect these new models to become a major portion of their total hardware volume over time.
Where do they see the biggest opportunity for these new AC products?
They mentioned both North America, where they already have #1 AC share but see potential for more volume, and significantly Europe.
Europe, why specifically?
because they felt they haven't really had a competitively positioned product in this particular AC category for Europe before. This new architecture allows them to address that gap.
When do these start rolling out?
The first product based on this, a European home and fleet charger, is expected to start production in July, so pretty soon.
Okay, so these two things, Eaton and the new AC hardware, sound like the core pillars of their growth strategy right now.
That was definitely the takeaway from the call. They summarized by saying they're ahead of schedule on their year 2 strategic priorities, growth and innovation. They feel they're now set up to really benefit from their lower cost structure and this refreshed portfolio in year 3.
Eaton for immediate channel access, the AC hardware for volume, market share, and margin expansion.
Exactly. Eaton unlocks growth now. The AC hardware fuels it going forward with better economics.
All right, so with all that context, what do they actually guide for the next quarter, Q2?
For the second quarter of fiscal 26, they guided revenue to be between $90 million and $100 million.
$90 to $100 million. That midpoint, $95 million, is actually slightly below the $98 million they just reported for Q1. Why the caution?
They give a few reasons. Continued uncertainty in the macro environment, lingering questions around tariffs, and also just the near-term operational focus needed to get this big Eaton partnership up and running smoothly.
So basically, don't expect the Eaton impact to fully hit in Q2, and acknowledging some ongoing headwinds.
Seems that way. A dose of near-term caution in the formal guidance.
But does that change their view on the full year? They still seem optimistic about hitting positive adjusted EBITDA this year.
They absolutely reiterated that optimism for the second half of the year. They still expect revenue upside later on.
Driven by what, specifically?
Driven by the ramp-up of that new AC hardware we just talked about, potentially better performance in Europe as conditions improve or the new product launches, and the growth kicking in from the Eaton partnership once it's fully operationalized.
Okay, so the message is Q2 might be a bit muted, but expect acceleration in the second half.
That's the narrative they presented. And they doubled down on the focus. Revenue growth, margin expansion, cost management, all driving towards that positive adjusted EBITDA goal within FY26.
Anything interesting pop up in the Q&A portion of the call?
A few things reinforce the main points. Management stressed that getting Eaton operational is really key for Q2 and Q3 revenue trajectory.
And international expansion through Eaton.
They said the capability is there for lots of regions, but the initial focus with Eaton is squarely on North America and Europe. That's where they see the biggest immediate addressable market for the combined offering.
What about inventory reduction? When will that really kick in?
They expect it to be gradual in Q2, but become more meaningful in the second half of the year, assuming revenue growth picks up as they expect and they sell through that existing stock.
Okay, got it. Now let's move to our final segment. And just to be crystal clear, what we're about to discuss is purely a speculative thought exercise. It's based only on the information from this earnings call. It is absolutely not financial advice, not a recommendation, not a prediction, just connecting some dots from what management said.
Right. A mental what-if scenario based solely on their narrative. So here's the setup. Management guides Q2 revenue cautiously, maybe flat to slightly down from Q1. But then you hear all this positive language about the second half.
Yeah. Really strong emphasis on the potential scale of Eaton, the volume and margin boost from the new AC hardware, cost cuts outweighing tariffs, and sticking firmly to that goal of hitting positive adjusted EBITDA this fiscal year.
So, the potential disconnect, or the outrageous but plausible scenario derived only from their words, is this. Could the market be too focused on the Q2 caution? Could it be underestimating the potential for a sharper upturn in the second half?
Meaning, if you take management's optimism about H2 at face value, the combined impact of Eaton really kicking in, the new AC products driving volume and margin in both NA and Europe, plus continued cost control, could that lead to a faster or more significant improvement in revenue and profitability than the cautious Q2 guide might imply?
That's the question the call narrative raises. Could that convergence of catalysts create a more pronounced positive inflection point later this year than maybe current sentiment reflects?
It's a fascinating juxtaposition. Again, purely speculation based on the call's content. Not advice. Do your own homework.
Absolutely critical disclaimer.
Okay, that wraps up our deep dive into ChargePoint's Q1 fiscal 2026 earnings call.
We covered the key financials, revenue in line, but strong margin improvement. We looked at the drivers, particularly the growing high-margin subscription business.
We discussed the cost management efforts and the clear focus on reaching positive adjusted EBITDA this year. And we unpacked those big strategic moves, the Eaton partnership and the new AC hardware architecture.
All aimed at driving growth, gaining share and improving profitability, despite that near-term caution reflected in the Q2 guidance.
Hopefully this gave you a much clearer picture of what was discussed on the call and the key things to watch going forward.
Remember, this was about understanding the information they presented. Use these takeaways as a starting point for your own thinking and research.
Thanks for joining us on the deep dive. We'll talk to you next time.